Yeah. So what is this ETF data or bond market data? For what we are using this? This bond market data will consider as a risk-free return. So bond yield is regarded as the risk-free yield or risk-free return. We can say RF. Then you can also calculate the bond market return and convert it into monthly. The way we did the SPI, the same way we are doing for the bond market. You import that SPAB file, that is bond market ETF data. Now you can calculate the adjust the date and calculate the return by changing the name of the columns. Okay, so the return will appear with you. Now you have SPI return, that is your stock return, as well as your risk-free return. Now what is your task is you want to combine these two. One is this risk-free return, another is the stock return. How you will combine these two? How you will combine these two? Just say again, you are saying like we are getting one blank row. Why we are getting this blank row?
So because your return calculation is dependent on the previous value as well.
Yes. So since this one is not having your previous value, that's why NA. So we want to omit this first row before we move forward for our analysis. That's how we are removing this first row. How we will remove? In R, the first one is row, then you just say comma, then the second part is the column. So when you say -1 or -2, you are omitting that -2 rows or -1th row. So when you say -1, this one will be removed from both the files. So we have SPI return, we have log return. Okay. Now just say we have removed and we are getting this SPI return is NA. All of you are getting this SPI return? All of you are getting SPI return?
Yes, sir.
What happens to my...
Got it, sir. Got it.
I am getting NA. It is coming. Okay, so I have given this R is small r, but here the R is capital R. That is the reason. Now it will come. Oh, this is also smaller only.
But in the file which you sent, it was not showing any error.
Yeah, that is what it was not showing any error. I have missed to run some command, might be. Let me run from first. Okay, all of you keep on running those things. I have written all the steps also. Calculate mean and standard deviation. I'll just look into the problem, my problem. Please keep on running the commands and see how it is, how you are getting the efficient frontier.
Up till step 3, there is no issue.
Sorry, up to
Up
no.
till step 3, there is no issue at all. The issue comes when we're trying to compute the target return.
This is step 2 only.
Step 3, sir. Step 3, once I just run step 3 and there is no error in that.
Yeah, there was no error. I run yesterday also.
So shall we send you the syntax once again?
No, the same one only I am using. I have something on this data file. Okay, but anyway, maybe for me result may not come, but all of you are getting result, right?
No,
Sir,
sir, we're
it's
not.
Kenya only.
In step 4, there is an error, sir.
Okay. Step 4, what is the error? HP return will come now and then. Okay, what is the error in step 4? Can anyone share your screen and say only your,
Shall I
yeah,
shall I
please,
share mine?
please.
Yeah, you can see my screen, right, sir?
Yeah, you can go to your R.
Yeah.
Yes.
I'm not sure how to zoom in on this.
You can go to view. It's visible also.
Okay, sure. So I'll just start from the top, okay? I've made some changes in the code because I've added my own comments at some points. So I'll just run 3 steps at a time. That'll work, right?
Yeah, that will work. Not a problem.
Okay, so step 1 to step 3, I'm not getting any errors.
Hmm.
Up till step 6 also, I'm not getting any errors.
Okay.
Step 7 is where the error comes up. Surprisingly, it's not cool. You can see, right? Step 10, I've done. Up
Yeah.
to step 10.
No, this is not error. That NA is coming. No? That is what you are saying error.
This one. Oh,
Yeah.
this one you mean? Okay,
NA,
okay.
yes. NA is not the error.
No, sir, I
There
was
are
getting
some
another
missing
error as
things
well.
in the data set. Yes.
No, I was getting another error as well. Somewhere down. Maybe it was here.
Okay. That point will go. Just complete this previous one.
Yeah. So we were at step 10. Over here, I'm getting the error. It's mainly because of these NA values. It's not able to
Yes,
plot.
yes, yes, yes. Somewhere something has been missed. That's why maybe it is in the data set only. Data is correct only. Okay. All of you are facing the same problem in that step 12.
Yes, sir.
Sir, the problem, if you see, it starts from step 3 itself when we have an NA
NA,
value over here.
NA, NA,
Even in
right?
step 2 as well, sir. The standard and post return over here also it's NA. So it starts from here actually, from step 2.
Yeah, this NA only. I was also getting this NA. That is what I was asking whether you are getting same NA. This in the step 2 NA you are getting, na, that SPI return.
Yes, sir, yes.
Yeah, that is correct only. -1 we are doing only for. Yeah, just run that one once again.
Step 2.
2.
Okay. Just 1 second. Sir. No, sir, not working.
These errors should not come.
Sir, over here, before we proceed, can we just simply drop this one line? So if we drop it, maybe then it will compute. My guess is when it's trying to compute the data right now, it's
We
not.
are dropping, na?
We are not dropping it, sir, are we?
Yeah, just go down. We are dropping that SPI return -1.
This one.
Yes, that's why we are
Okay.
dropping there -1 first row. First
Okay.
row is that one only. Okay, give me 1 minute. Yes. So let us do it through Python. I'll come back to that R problem. So I'm sending you some Python file. Okay. I have sent you some Python files. Just check that and download those files. Along with one data set also I have sent you.
Sir, I have a question to ask.
Yes.
Sir, why do you use R and Python whereas Excel is much more easier and friendly to do so?
Yeah, Excel will not do. Excel has some limitation of doing this portfolio maximization. First one is R and Python are good for considering a large database and data sets. In Excel, you will manually calculate for this portfolio maximization, and you can go maximum to 4, not more than 4 companies. In R and Python, you can go for n number of companies.
Okay, sir. Because coding is a bit more complicated with R and Python compared to Excel.
See,
That is
it's
the
easy actually. It's not complicated. Once we start on using it, it will be very easy. It's not complicated. Only thing is we are used to, since our childhood, we are used to with Excel. That's why it is looking like. But whenever you will deal with big data and new models, Excel will not able to do that. Excel, if you will able to do, Excel will take lots of time. Even the time series econometrics, you can do all models through Excel, but it will consume too much of time. But in one command, you can get those results from R or Python.
okay, sir. Thank you.
Okay. So all of you got the files?
Yes, sir, we got it.
Yeah. So first one is you go for I have given you random weight, right? So open with Jupyter Notebook. All of you have opened. Open your those files with Jupyter Notebook.
So random weight or the other one?
Random weight NSCPY.
Okay.
Okay. The other one is also random weight adjusted closing price. See, there are two closing prices. Why not say? There are two closing prices. One we are getting as closing prices. Another is we are getting as adjusted closing prices. Uh, what is the difference between this closing price and adjusted closing price?
So the adjusted one takes into account the historical corporate actions which have happened up to the stock.
Yes.
So it's
So
better for your analysis.
whenever we are considering this closing price, we are omitting the corporate actions. Whenever we are taking this adjusted closing price, it is adjusted with corporate actions. That's why adjusted closing price is more meaningful to consider for analysis as compared to closing price. Now I'll show you what is the problem we will face through closing price and what is the solution we will get through adjusted closing price. So the adjusted closing price data we have shared with you with a Excel sheet Sensex companies. Now we'll see some of the closing price data. Directly you can import. There is a package called NSCPY. This package gives you all the listed companies of NSC's data. Okay, so you need not go to any of the database to download. You can directly download through Python over here. Okay, now if you have not installed, you just remove this hash and install it. Just install that NSCPY. Then we need certain library to import. I hope all of you are having pandas and numpy and matplotlib. Since you have worked, all of you are having these libraries.
Yes, sir, we have it
Yeah.
installed.
Yes,
Yes, NumPy. It comes with Jupyter itself, so most of it.
Yeah. So only you need this NSCPY to install. NSCPY to install. Then you run through to import these pandas and import numpy and import matplotlib, then import c1 and sci py for this optimization, portfolio optimization. Then plot style, we give this 538 on style is there, uh, that line will come, and np random, you just give that standardized 777, then matplotlib and configuration. Then we the second one is only for the colors. What are when we are using different stock prices, we want to place them in with different colors. Now from NSCPY you import get history. Okay, then from date time import date, so that we'll get the historical data of the stocks that we want. The second part is we need to give the symbols. Whatever data we want, we need to give these NSC symbols. So I have given you some of the stocks. You can see Hindalco, Wipro, Power Grid, Hero Motor, ONGC, and UPL. So some of the symbols has been given. Just run that symbols. Then we want from which date to which date you want data. You can say 2019 to 2021. Then till date also you can give, like the format is YY month then year. You can give whatever date structure or whatever sequence of data you want or number of observation you want.
So
Suppose
NOA, are we counting as the number of columns?
number of columns, no. Number of columns we are not counting. N number of columns you can import.
So what is NOA? I'm so sorry about that.
Sorry?
NOA equals to length of symbols.
Huh.
So what is NOA? Is that a number of columns we are considering? I'm not understanding that.
Not number of columns. This is number of columns is this only Hindalco. Yes, yes. This NOA is number of columns. This Hindalco Wipro, these are coming on columns. The date is not coming on columns.
Okay, so
Date
we are
will be
using
there.
date. We are using date as an indexation.
Yeah. Date will come in the as a row. Okay. So you give start date and end date, any date you can give. Okay. Now you can say you can just use in the get history. Get history, give symbol name as SYM, or you have given SYM for symbol. Then start equals to start date, end equals to end date. Then you want close price, just say close. Then data dot column equals to symbols. So in the column symbols will come. Now you can see it will import data directly from NAC. Yes. Now you
There
can
is one
see.
question.
Yes.
As far as I know, you cannot download historic data for more than 1 year from NSC's site.
No, that is from NSC website directly. But this package will give you more data. This is
Acha,
through
okay.
Python. You can download a large
I can
number.
download so I can download for as long as I want, right? For as far as I
Yes,
want. I
yes,
can
yes, yes. That
Okay,
is
now
what
one more
the
thing, sir.
benefit you. Yeah.
Suppose I take 20 years of returns, for example. Like, I want, suppose I want prices for 20 years. Now, there are companies which have listed only 2 years back or only 3 years back.
Those are will come NA. Those data you will not get.
Basically, yeah, so then these will be all blanks, right? These will all be NA values then.
Yes, yes.
But then when we are computing the returns, do we have to modify our code for these values, or how
Yeah,
does that
we
work?
have to remove those NAs before we proceed for calculating the return or using that data. We'll do that. See,
Okay.
there will be so many companies, they will not have trade on some of the days. Okay, either they are having surveillance measures, or just like you said, they just came into listed 2 years or 5 years back when you are considering 10 years data. So those things you have to clean the data before you use for the analysis. The data cleaning is more important. Okay. So all of you got those data.
Yes, sir.
Okay. You can see the head of the data. Just see, Infratel is having NA. Okay, others are having all the data, but Infratel is having NA. Now you see the data information, and see, Infratel is coming as object. All are in the float. So you can't use this Infratel because this is not having any data. So you need to remove this Infratel. You need not consider this Infratel for your analysis. Okay. Now you can see in the table, you just put that data. Now you can just plot whatever data you have imported. Just see their prices, how it looks like, or what are the price movements. Simply you can see. This is for the on the raw data only. You are seeing the
So shouldn't we drop Infratel as you just mentioned?
yes.
Shouldn't we drop Infratel right now?
Yeah, and right now, so we have not gone for analysis. In analysis,
Okay.
we'll drop. So right now, we are just seeing how this data are. Okay. So you can see Infratel will not have anything over here.
So just one more question also.
Yeah.
If you go a little bit, yeah. So where this LW is equal to 3 and alpha equals to 0.8, what do these stand for?
uh, these are for plotting. We need this what do you say, indent or the size. That is what we need
So,
to.
Ali,
Yeah,
possibly LW might be line width, and alpha
yeah,
might
line
be the
width.
transparency of the line color.
Yeah,
Acha,
yeah,
okay.
line width. Yes, line width.
Yeah,
Got it. Thanks,
and
Neil.
and the label is coming according to, I think, columns. I'm not sure about that.
Yeah,
And
No,
label
that part I
is
understood.
based on the column.
Got it. Okay.
Yeah. Okay. So all of you are getting this plot. Now we can't use these say raw data because we need the return when we are doing the return in R. How we are doing? We are using the quant mode package and we are using daily return command, or we are using the delt as well. Uh, or you can in R also you can do something called log return also, difference of log. Three ways you can do through R. Here you just say we have kept our data in the table. Just say PCT underscore change will give you return. Okay. Now we'll apply this percentage change or PCT change of that raw file. Now you can say return equals to table.pct change. Then you want to plot that return. You can say figure size, then all the plot details. So you can see the return file is or the return series are plotted, and this will be stationary or this will be stationary. Someone was asking on the other day like why we are not going for time series mean. So
the
this
latter is stationary.
yeah, so the return will be stationary because it has brought down all the information into a constant mean and constant variance. Now we'll go for calculating minimum return, maximum return, minimum risk, and using the portfolio theory. Okay. Now you can see first we want this annualized performance. We need, there are two weights. One weight is random weight, another is static weight. When we say static weight, if I have to invest in 10 companies, I will equally divide all of my portfolio into those 10 companies. When we say random weight, I'll give based on its performance. Based on the performance. Now, this whenever you want static weight, you can use this one. Okay. I have kept it in the by putting the star hash, so it is in inactive mode. So you can use now random weight. Now that random weight depends on the performance of the stock, then of the stocks in a portfolio. Then it will it will give more weights to the better performed stocks as compared to lower performed stocks. Okay. Then we want standard deviation and return, or say portfolio standard deviation and portfolio return. Then we want risk premium, okay, or portfolio return minus risk-free return, and we can divide with the portfolio standard deviation. So we need for annualized performance along with weights. So this is, you just define this, then you can come out with a return we want to use is percentage change, then mean return, then covariance matrix, then number of portfolios. See, this number of portfolios is the simulation that we want to see if we are constructing one portfolio, or we are constructing 500 portfolio or 5,000 portfolio or 25,000 portfolio, in which part it is in all the part which is our minimum risk and maximum return. And say risk-free rate is 0.01. It depends on what risk-free asset you are considering, or risk-free rate of return, which one you are considering. It depends on that. So suppose you are considering 0.0178. Now you display the simulated portfolio with random weights. Okay, if you do that, all this, okay, one is Sharpe ratio we are using over here also. What is that Sharpe ratio? It is the risk adjusted return. Okay.
RP minus RM divided by standard deviation.
Yes, RP minus RM by standard deviation. That is the risk adjusted return. So it will give us, that means higher the Sharpe ratio, better it is, or lower the Sharpe ratio, better it is.
Sir, I guess higher.
Higher is better, I guess.
We want always higher Sharpe ratio. So we will consider over here higher Sharpe ratio, so as to get the better performed stocks in our portfolio. Okay. Then we are getting this Sharpe ratio. Then we want minimum say volatility or minimum risk. So maximum return and minimum risk. Then we will print all those whatever we have done so far. We will print all those results, and we will see how much we are getting into, or uh, how much our portfolio looks like, or how we can maximize our return and minimize our risk. Okay. If you come down, the curve is not coming. This is the curve, it should come. The curve is not coming. Why it is not coming, I'll tell you. Now, if you see, whenever we are saying maximum Sharpe ratio, the annualized return we are getting is 0.02. The annualized volatility is missing. Now,
Sir, in my code, it's giving me error, sir.
what error?
So the error is it's saying, 1 second, maximum name max Sharpe ratio is not defined.
One second. No, whatever I have given you, I am using that only. Why it is saying not defined?
So, sir, I think maybe the order of codes I would have run in a. I'll just
Yeah,
rerun them.
you have missed someone to run before that. Yeah, just or maintain the order. So in one company we are getting 0, 0. That is Infratel, right? Or what? NN? What was that? Yes, Infratel. So because of Infratel, maybe this portfolio is getting disturbed. We'll just remove this Infratel. So all of you are getting?
Sir, if you run the code from top to bottom, there are no issues. And in the last diagram, there is a proper risk return framework.
Yes, what you are saying, Neil? Who are saying? Neil, yes.
So I'm
Neil.
saying if you run the code from top to bottom, everything runs,
Hmm.
and in the last diagram there is a risk return framework which comes with all the dots, sir.
This one.
So below this, the last one, sir.
This
Yeah,
one.
yeah, this one
Okay.
comes.
Yeah. Yes, actually, our umbrella is not coming with this closing price uh, because it is not able to maximize properly. But if you see, the maximum Sharpe ratio will be given in this star and minimum volatility will be in the blue star. So maximum Sharpe ratio will give, if we take higher risk, we are getting higher return. So risk adjusted return will be high in this case of maximum Sharpe ratio, and efficient frontier is not coming over here. Now what we will do is we'll go back to our
So just
uh,
one question.
yeah.
Just to so I understood the code and all. My question is, what exactly did we do? So my understanding is we have asked Python to create multiple combinations of portfolios with different weightages. And is that how it is computing this
No,
graph? What exactly is happening?
weightage we are not giving. Weightage is two types of weights. One is random, another is static. When you say static, then weights we are giving. When you say random, we are not giving weights. Okay,
Okay, so what
weight
are we
will
doing
be
exactly?
considered based on the performance of that stock. Okay, better perform stock will be assigned with higher weights. I'll show you one result to you. Yes, just see, this allocation was static. That's why you are getting 10% with each of these stocks. Okay, so if you, what it is indicating, if you assign 10% weights to each of the, or 10% of your total portfolio, or total value of your portfolio, you will assign to each of these companies, you will come out with a negative return by 12% or 0.12%. Okay, if you give this static weight, okay, again this is also static. This one is good one. This one we want. Okay, I'll show you. Yes, this is one random portfolio. We have all these companies. What it is saying, don't invest in Wipro, Hindalco, or Power Grid, or Hero Motor. You can go for Asian Paint maximum, and Infratel is little bit. So that's how it is saying, but
But
it
sir,
is again
infratel
having
was an
some
NA value,
problem.
right?
Yes,
Infratel was an NA value, right?
which one?
Infratel,
Yeah,
that was an NA value, right, sir?
NA value for some data period. I hope that's why it is allocating something.
Acha, okay. Okay,
Uh,
that is the one more thing.
yeah.
Now, as per this, so this would, no matter which stock we give it, it will always select just one stock out of,
No,
out of the entire
not
basket.
one, not one. So this is one exception. That's why we can't believe on this. Yes, Asian Paint is good company. We can go for, but allocating whole of your
Exactly.
portfolio to Asian Paint is not good. So this is again a problem. By considering the closing price only, we are getting this problem. This is only closing, not adjusted closing. Another allocation, I'll say. So here it is like static only. So thousand rupees you allocate in each of these. So here we have divided into static. Now just go to this random portfolio of using that Sensex data. I have sent you an Excel file of Sensex companies. Um, these two are using the closing price data. See, from NSE PY, you are not getting the adjusted closing price. Okay. You are getting the closing price. For practice, it is good, but not for application. So for practice, you can use that closing price and see that. But for application, you should get this adjusted closing price that is given by ProS only, or capital line, CMI ProS, or you can go for capital line. Okay. So now you can use this one, whichever is giving you, say you use this data set. Other things are same only. So use this Sensex companies. Use the Sensex companies, all the 30 companies data you have, you use that data. Then you calculate the see the data column and calculate the return of these particular variables. Data.save, that is not required. So just adjust the dates, define the date as date and month year style. And if you see, yes, so if you see, the save is that for 27 say rows and 33 columns. The two columns are date and the index. Yeah, month and year we have. Actually, if we don't want month and year to give, then we may omit this. Month and year and date, these three are the three extra columns, or else 30 companies there are there, or prices are there, closing prices are there. Now simply say we want data. The first condition is monthly data, then which is year equals to 2020. You can filter those date. You want filter condition 1 and 2 at a time to apply in the data. So you can get only data of 2020. Okay. Not by up to 2020. That means 19 to up to 2020. So you can get those data sets, and you can come out with calculating the return. So you use some of the companies from that data set, or all of the companies. So you can use 5 companies, 10 companies, 20 companies, and try to see. Then come out with a filtered data with symbol, and set the index. Then you will get the.
So this is the same syntax, right, as this as the previous file. Only thing is we are using adjusted close right here.
Yes, adjusted close.
Rest everything is the same, correct?
Yeah, mostly same. Actually, this data file we are dealing with some of the extra symbols and other parts, because we have imported through Excel sheets. So there we have imported directly through NSCPUI package. It is inbuilt package, or means from the package only.
Okay.
So now you can plot those. Suppose say 4 companies we are considering: Asian Paint, Bajaj, SCL, and HDFC. Now out of that, now you calculate the percentage change, or the return of those companies. Okay, when you say return of those companies and you plot, return will be plotted. Now the same way we will see the annualized performance and random portfolio. So we'll see how much between these 4 companies, how much we can allocate to Asian Paint, Bajaj Auto, SCL, and HDFC, so that we will come out with minimum say risk and maximum return.
Excuse me, sir.
Yes.
Sir, how we filtered these 4 companies?
We have written these 4 companies we want in the symbol. You can take more than 4
We
companies.
just randomly took any code.
Yeah, randomly we are considering. You can consider all the companies at a time. 20 companies, 10 companies also. but we are considering 4 companies for this. Okay. So, like we want portfolio standard deviation, portfolio return, and the risk premium. Then you can calculate those. Okay, calculate those and see how much we are getting.
There is one question. I'm really sorry. I'm sure
Yeah.
you have explained this. So above when you go, there is one place where you've written 25,000. What exactly is that 25,000?
So this 25,000 is 25,000 times of simulated portfolio. So you
What
are
difference does
doing,
it make, sir?
yes.
So what difference does it make?
Yeah, what it is, suppose you are constructing one portfolio, you are getting, suppose say 0.05% return and 0.02% say volatility. Okay, now you want to maximize return and minimize volatility or risk. What you need to do, you create several kinds of portfolios and see how much, if you run 25,000 or 5,000 portfolio, what is the minimum risk or maximum return you are getting. If I am simulating 25,000 times and I am getting confirmed that I will come with this much return and this much volatility, then that confidence of the result will increase. Or
Okay,
the,
two questions then.
yeah,
One, we are all these 25,000 portfolios will be built by the same 4 companies, right?
yes,
So in that case, it's gonna assign different weightages in each
it is,
portfolio and calculate that, right?
yeah, yeah,
Okay, so that is one. Second thing is, sir, this is still stochastic, right?
yeah.
So, like, should we assume that the confidence interval is gonna be 95% or what exactly? Like,
Yeah, confidence interval is 95% always we are
assuming,
considering,
but
assuming.
there is no way to actually see, like, what, like, like we
Yeah,
are.
yeah. So there is no we don't see the confidence interval on that sense. We see on two sense, like if say efficient frontier is built in a good manner, that means our bell curve is coming. Okay, efficient frontier curve is coming, then that is good. Again, it should link with our minimum volatility point and maximum return points, or say risk adjusted return. And yeah, so this is Sharpe ratio, or risk adjusted return. This is the minimum volatility point. So then we can say this is built correctly. We don't go for seeing the probability and interval in just like in time series we see. Are you getting, Ali?
Sir, not entirely clear, but I'll read more on this. Maybe I've missed some things.
Okay. See, I'll tell you. Whenever we are saying we are getting one result, we are coming out with some confidence interval so that we can say believe that result, or we can trust that result, right? So
Correct.
either confidence interval or probability value we are coming out with. Okay. Here in the model, in the portfolio maximization model, we don't report these two. Only when we will come out with trusting the result, or whenever we are coming out uh, with a say uh, good efficient frontier, or a efficient frontier is built good. Suppose one efficient frontier is like this, okay, or like this, then that is a wrong one. If efficient frontier is like a umbrella that we have seen in case of correlation, if we will our efficient frontier or our curve will be efficiently built, then each one will give us good amount of profit or good amount of value when we diversify with different companies. That is the whole idea of trusting this result, not by looking into confidence interval and the uh, and the
Okay. In
probability.
that case, sir, what do we do when we don't get that envelope curve? Like,
We
it's
need to
possible that the market data is just simply not creating an envelope curve in that time.
yeah.
So at that time, can we say that this portfolio theory will not work in this situation?
See, portfolio theory will not work. We can't say immediately. What we need to see is how much time horizon we have considered. Then, what are the stocks we have considered in that portfolio? We can increase the number of stock, or we can change the stock, and or we can increase the number of observation. Then only we can come out with whether we are building a efficient portfolio or not. Okay. So in a one test, say if you come out with different stocks, their behavior is different. If you are putting them into one portfolio, it may happen that one company may creates a disturbance, so that your efficient portfolio may not come. So whenever you are building this efficient portfolio, you should be carefully considering the company, so that you will not come out with a inefficient portfolio. Okay. So 2 years back, I have done so much of this efficient frontier. Earlier, I was doing through Excel. Whenever I started doing through R and Python, this curve I was not getting. Okay, sometimes I was getting a straight line curve. So that is the wrong. Whenever you are getting one optimized or efficient frontier as a straight line, then that is totally wrong. Okay. So you need to build it from different sectors. If you consider the stocks, then again the time horizon will be more. Then you will come out with a confidence portfolio. If still that is not happening, then you can't consider those companies in your portfolio. That means you should not consider those companies. You change the companies.
Okay. So one more question. I'm really sorry. Like we can
No,
again.
no issue.
Later
Please,
also.
please.
Okay. Now,
Why
can
you
this
are saying
work
so?
with mutual funds, sir?
Yeah.
Because mutual funds themselves are baskets that have been calculated based on efficient frontiers. So can we try and build an efficient frontier of multiple, basically a portfolio of different mutual funds? Would that be possible? Because data would be available. Daily
Different
NAVs we
mutual
can take.
funds are,
So we can take daily NAVs for that, sir.
sorry.
We can take daily NAV values, but
Yeah.
does it make sense of actually creating a
Now,
frontier of that?
yes. That scheme will work you as a company. You can say as a price. NAV price will consider you, means it will act as a share price for you. Then you see which scheme will give you good say maximum return and minimum risk. You can do that.
But does it make sense to actually create an efficient frontier of different funds?
Yeah, it will make sense.
Okay.
Why it will not make sense? It will make sense, definitely.
Okay. Just one complication that can arise with this.
Yeah.
Each fund has a different annual charge, right? What we
Yeah.
call kind of a maintenance charge. So how do we adjust for that?
That is the tracking error. Expense ratio.
Yeah, correct.
So this expense ratio is different from different funds. Either you can for the expense ratio you can adjust, or you can take the expense ratio, the funds whose expense ratio is with certain range, say 1 to 2%, or 1 to 1.5%, or 1 to 1.2%. So you can consider funds with almost same expense ratio. If we are comparing with a very large expense ratio, those actively managed funds are having more like high expense ratio. So you have to consider the similar kind of expense ratio. That is one. Or else, whenever we come out with return, you can adjust with the expense ratio, but again each one's expense ratio is different. Yeah. So similar type of expense ratio you can take, or within a range of expense ratio, you consider those funds which are having a range of expense ratio or similar range of expense ratio.
Okay, sir. I'll read more on this then.
Yeah. Okay. So, okay. Now, all of you have run through. All of you have run through. What you are getting over here is, if you consider this Asian Paint, Bajaj Auto, SCL Technologies, and HDFC Bank in your portfolio, you will come out with a annualized return of 0.23 and annualized volatility of 0.14. If you put 42.75% of your total fund or total money into Asian Paint, 15% allocation to 15.6% to Bajaj Auto, 39% to SCL, and 1.87 to HDFC. This is what we are saying is the random portfolio that we come out with. Okay, and the condition is maximum Sharpe ratio allocation. Like we want risk adjusted return, how much it will be. The second condition is minimum volatility. In minimum volatility, if you opt for, then you will come out with annualized return of 19%. Here you are taking some amount of extra risk, that's why return was 0.23%. Now annualized volatility of 0.13%. Now if you are coming out, how much allocation will give if you want minimum volatility? In Asian Paint, you give 14.28. In Bajaj Auto, 23.15. SCL, you give 35.95. And HDFC, 26.163. You can see what make the more changes or the whenever we shift from maximum Sharpe ratio to minimum volatility, HDFC Bank is getting high weightage. Okay, and the weightage of Asian Paint is coming down. Okay, Bajaj Auto has gone up, weight to Bajaj Auto has gone up, and SCL Technology, it has come down. Okay, so what it indicates? It indicates if we are risk averse, we can go for minimum volatility. If we are risk takers, we can go for maximum Sharpe ratio. If we are going for maximum Sharpe ratio, we will come out with a higher return, but the volatility is also high. And if we are coming with minimum portfolio allocation or minimum volatility of the portfolio, will come out with a little less return than the maximum Sharpe ratio allocation, and annualized volatility will be less as compared to Sharpe ratio. So if you are coming over here, you are getting in your portfolio, you will be here as maximum Sharpe ratio, and in the blue star will be your minimum volatility. Okay. Up to this, all of you got it?
Yes, sir.
Okay. Now you can try with other companies. Whenever you go back, you can keep on adding and try with other companies. Now we will see each stock wise where we can place them in this maximum in this efficient frontier. So you give the constraint, then you come out with defining Sharpe ratio and portfolio volatility and minimum return. If you come down, you will get the again optimizing that efficient frontier. If you optimize that, you are getting the same return of say annualized return of 23% and volatility 14%. Here 19% return and 13% volatility. Only difference is the HDFC allocation has increased by 1% and Asian Paint allocation has decreased by 1%. Others are almost same. And over here also almost HDFC has gone up from this 2% to 26%. So what we are getting from these two, one is we are optimizing for this risk return, another is only we are considering the risk return of the portfolio. So what we are getting over here is uh, whether we want whether we want maximum Sharpe ratio or minimum volatility. So these two we have to select, then based on that we have to allocate our total portfolio value with them. Now if you come to individual level, Asian Paint you can see is giving higher return, or it's a higher risk as well as higher return. SCL, Bajaj Auto and HDFC are as compared to Asian Paint are less risky. Okay. That is what efficient frontier tells us.
So what about that straight line which we have above Asian Paints? There is a straight line. How do we
Yeah.
interpret that?
Yeah, this should not come actually. This straight line we don't expect this. This should not come. It has to be a umbrella part. So there are some wrong part over here. That's why this straight line is coming. That means we can now build up with different say different companies, or we can keep on adding other companies. So this should go, then only we can say our results are robust, or our results are say you are saying like whether we are in the confidence interval or not. Okay.
So how can we check efficiency of this?
This
Yes.
curve,
Yeah,
yeah,
yes,
it
yes.
should not happen like straight one, or it should be with the this one also not good. This straight line also came. So this type of straight line should not come. This umbrella should come, like efficient frontier should come. Okay, then you can say it is built efficiently, or we can strongly accept that. Okay.
So when can we observe those kind of, like, what's the reason? Why are we observing that
The
straight?
reason is we have seen when we are doing this correlation, we have seen yes, the reason is this only. We are saying if diversification happens with a more bell type of curve, then we are getting good economic value. That means correlation among these companies are either negative, or or they are having less correlated. Okay, this one is less correlated. This one is zero correlation. Yeah, zero correlation, and others are negative correlation. This one is less correlated. This 0.50. If we this type of curve is also coming, still we are getting some amount of benefit. If straight line will come, that means your stocks are highly correlated. I mean, say their correlation is 1 plus 1. Then you will get benefit out of this. Can you get benefit out of this?
No, sir. Maybe.
You will not get benefit if you are keeping both of them very highly correlated. But it depends on the, again, if you are seeing in a very long period, then that is different. But based on the portfolio theory, this should not be your portfolio, or you should not consider this in your portfolio. So the base you are getting, Neil, or who was asking, the base is this only, the correlation. Are you getting, Neil?
No, sir, I was not asking, but I am not getting that spread, sir. I ran the entire code. I'm just getting singular dots.
So which best correlation you just now mentioned?
Best correlation is -1 only. That means for our
Okay.
diversification, -1 is the best. Then -50 or 0 correlation, or you are coming with +50. But it should not be with the +1. Neil, what you are not getting? You are saying?
Sir, I think I would have made some change in the code, and I think now that spread is not coming, like the curve spread. So I am just uploading someone else's IPYNB file, sir.
Okay. Okay. So all of you can now use all your data that you are having, or you can use 30 companies data are available in this Sensex. Or you can also do some trial and error method using this NSCPUI dataset from NSCPUI. You can practice this so that you will come out with which is actually you are, suppose you are having 10 companies or 15 companies or 20 companies to invest. You can come out with a efficient frontier on this, and you can decide how much you can allocate from your portfolio to these companies. So can you do now?
Sir, just one question actually.
Yes.
One, when it comes to real life, like building somebody's portfolio in real life, what should be the period for which you actually compute the returns?
So 3 to 5 years mostly are taken, but
Okay.
more the period better it is. But it depends again. If you consider more periods, then the business cycle is different
Okay.
of different periods. So 3 to 5 years is good enough. But you can always cross check with the maximum period. In the maximum data that is available for that particular companies, how much we are getting, and if we are considering last 3 years or 5 years, how much we are getting. Again, those are like swing traders, or they want to get benefit in less than 1 year. They also check 1 year, last 1 year's performance as well.
Okay. One more question, sir. How do we adjust for the risk profile of our client? Because everybody's gonna have a different
No,
risk
here
profile.
we are
Different
not.
pool.
Yeah. That is a good amount, like this PMS and other say advisors. They do risk profiling of their client. So here we are not doing. See, there are so many shortcomings of this portfolio maximization. This mean variance theory. There are so many say economists, they have criticized this, but the risk profiling came very late. When this model was built up, nothing was there in investment or portfolio theory. That's how the first model is built up. So this was the mud road. Then over and above, all these pakka roads are coming, and all these designings are coming. Those risk profiling is a very good thing. uh, those advisors, they do risk profiling of their clients so that they will not blame to the advisor, and they will also come out with a good amount of return with a certain companies which are having highly risky or low risky.
In that case, sir, this theory works best for which kind of risk profile? Can we assume the normal long-term investment?
One is who are risk taker, they will consider the Sharpe ratio.
Okay.
Who are risk averse, they will consider the minimum volatility range.
So it's either for the.
Yes.
So then we can say this. So then we can say this is either for the extremely aggressive kind or the very conservative kind.
Yes. Yes.
Anybody else should not ideally go for this kind of portfolio.
Anybody?
Uh, a- any other investor, any other type of investor should not opt for this kind of portfolio.
Any other means you are saying in between those high risky
Yes,
and
correct. Conservative and aggressive.
yeah, we can't generalize in that sense. We can tell them they can build up by considering this many stocks, but with certain conditions. They will Either if they are not going for maximum Sharpe and minimum volatility, if in between they are going, they will take their own decision, but they will get one overall idea that how much can be allocated in all those companies. So they can do their own allocation strategy.
Okay, so one last question.
Yeah.
How do we factor in different sectors? So like, I might want to build a portfolio of suppose 3 or 4 sectors. So I can run this code and find out which companies from each particular sector. But then the allocation given to each sector, how can I do that?
No, that say for each sector, now your part is to select the companies from each of the sector. Allocation will be given through the model itself, that is the randomized allocation based on the
No, so
performance
that's what
of
I'm
that.
saying. No? So instead of selecting the companies myself, so for example, I have come to a decision that I want my portfolio to be a combination of steel, basically metals, and auto sector.
Hmm.
For example, now
Hmm.
to select companies from the steel sector itself, can't I just simply build a portfolio with different
Yes,
weightages
yes, yes.
to
That is
companies
good
of steel
logic.
sector?
Yes, that is good logic. Yes, you can. You can. So out of these steel companies, which is good? That is what you are saying.
Yeah, exactly.
That is good. Only see, that is good when you are considering all the steel companies. You are coming out with this is the best performer.
Right.
Then you pick that best performer. Then use it with the portfolio that you are constructing with the other group of sectors. You can do that. That is a good
But
idea.
sir, over here, when I try and combine 2 different sectors, the correlation will again change, right? So
Yeah.
theoretically, that portfolio cannot be efficient.
You can't say like that. It cannot be efficient. It can be also efficient. Only thing here, you are getting the best performer or best stock of that industry. When you are getting that best, when you are including other companies of that industry, that is the best. Now you are doing one trial that if I am considering best companies from each of the industries and I am building the portfolio, how it looks like. So it may come out, it may not come out. You are also partly correct, because the correlation will be different when it is shifting to other sectors. You can try and see how much it is coming, whether you are coming out with a efficient frontier or not.
Okay, sure, sir. I'll give it a shot.
Yeah. So the R part we'll do it in next class. Now we'll do some of the basics of R with the one Kahoot we'll do, one quiz competition on basics of R. So please open your Kahoot, open one Kahoot, say Kahoot Play, and join with Kahoot Play. So use this game pin 5634975. All of you are able to see the game pin? Yeah, nearly has joined. So the Mondays will not be possible from now for me. We'll see how we can adjust that Monday class. Yes, please join quickly. Only Ali, Rahul, Raj, Neil, Diksha, Subham, Himanshi, Jaideep. Yeah, quickly join. Prasun, Rasi. So attendance will be taken from here only. Your name will come. So write down your initial names. Yeah, Cherry. There are 25 or more, 24, 22 candidates, 12, 13, Roma. Yeah, others are joining.
Yes, sir. Wait.
Shall we start? 17 have joined, 5, 6 have not joined. Okay, let us start. To set work directory, we use
Sir, I'm a little confused.
yes.
Uh, like it's just loading. I'm not understanding what is happening.
It's loading means you
I
can
mean,
see the options from the screen and select the color from your.
No, sir, it's loading. It says pure genius question mark and it's loading.
Yeah,
yeah.
yeah. Guys, if you have already selected, then it will wait till the timer runs out. Then you'll see the result.
Oh, I couldn't even see the options on. Okay, okay, okay. So I just okay. Sorry.
17 answer came. That means all of you have answered. Yes, set WD. All 17 have answered. Okay. 3 have said get WD. Get WD is to get the work directory. Ali, Raj, Himanshi, Meher, Neil. Yes, Neil is there in top 5.
So the question we have to see on the claim and answer there.
Yeah. So to get work directory in our yeah, 19 answer came. Yes, get WD. 14, correct. Ali, Prasan, Kirti, Himansu, Saranya. The C is used for Yes, vectors. Only Saranya Raj Service only person. To generate random numbers we use okay, Arnav. Saranya Service Raj Himanshi only. To combine two or more rows we use yes. To combine two columns in R Shiva and yes. To check the number of rows in dataset good and check the number of columns in a dataset. Yes. to check the number of rows and columns at a time. Oh, good. All 18 correct answer. To find out any missing value, if any missing values are there in the data set. Okay. To import CSV files to R, we use edit.csv, import.csv, Saranya Raj, Sarvesh Himanshi, Ali. To export CSV data file from R, to plot a series, yes. To see number of figures in one page, we use bar. Yes. Last question. We use test to see the line plot in R. Yes, good. So who are the top three? Himanshi third, Sarvesh second, Saranya first. Then Ali and Raj are fourth and fifth. Yes, Saranya 100% correct answer. So all your percentage of answers are here. Is this Muskan, Ayushi, Mansimaran, you have not answered? Okay, Muskan has joined here. Okay, so these are present. I'll mark in the attendance also. Okay. So next Monday, actually Mondays now will not be possible for me. We'll see. For some weeks we'll do only on Saturday and we'll identify one alternate day.
Sir, what is the syllabus for exam?
When is your exam?
Sir, 4th October, I think.
Okay, next class I'll tell. So whatever we have covered so far, you can study that. Next class I'll tell.
So this Monday we will have class or if there is no class?
Yeah. This month we have class. I am saying only this Monday we will not have class.
No, no, yeah, this Monday we don't have class. That's
We
what I'm
don't have
saying.
class.
So then we'll get to know the syllabus
So
1 week
this,
later. Yeah, which would be like 25th.
yeah.
So it would be nice if
I'll
we just,
share in the WhatsApp
yeah,
group
that would
we
be
have.
great.
Yes, I'll share in the WhatsApp. If I forget, just remind me. I'll share. Okay, thank you all.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you.